Hello again, this is Jim. In this video, I will show you 7 sure ways to crash and burn an IUL. We all would like to retire like this, and a properly designed and funded IUL can help you get there. You are probably considering an IUL because you don't want all of your money at risk. But if you do not follow some basic guidelines, it may not work for you as you had wanted, and your IUL might just crash and burn your retirement safety net. Why would you consider putting money into an IUL in the first place? Well, first, life insurance contracts provide tax benefits, tax-deferred growth, and the ability to get money out income tax-free through policy loans. And of course, death benefits have always been income tax-free to heirs. These tax benefits have been confirmed numerous times, even in 2020. An IUL mitigates inherent risk you would have by having your money directly in the market. Life insurance provides protection with death benefits and what is called living benefits, where you can get an advance of your death benefit in the event of critical health situations. This can be a real lifesaver. IUL is not a high-yield investment product. Mitigating risk does have an expense, but as you watch the videos on this channel, you will learn that you get a lot at a very low cost. Having your money in a safe place does not mean earning CD rates. Okay, here we go with the top 7. Number 1, not sticking to the funding plan. One of the best and worst things about IUL is the flexibility of premium versus the amount of death benefit. Let's say you allocate 100 grand over 5 years into an IUL. One advisor says you will get $2 million death benefit. The other knows you want cash accumulation, so they lower the death benefit to the IRS minimum of only $500,000. With policy A, a lot of the premium will go toward paying for the $2 million death benefit, and with policy B, more of your money will stay in the policy. Or let's say you need a $1 million death benefit, and you plan to fund with 10 grand a year per the illustration. The premium is just enough to carry the policy to life expectancy. But if you fund at 15 grand a year, you will have some excess cash. Why would you do this? Future flexibility. If you have a difficult financial year, you can opt to pay less premium or nothing. Doing this in the early years or multiple times can crater policy A quickly, as there is not enough extra cash in it. Keep in mind that admin fees and mortality charges continue to be paid even in zero earnings years. The extra premium would be a better way to plan for any future negative economic years, which no doubt will happen. Number 2, taking out policy loans too soon. I know there are IUL promoters on YouTube that say you can start taking money out in the 5th year right after funding. If you're doing a short-term loan for a few months or a year and pay it back, that's one thing. But taking out loans that will not be paid back, in general, this is not a good idea, but it does depend on the amount of the loan. These same people say that if you use a participating loan structure, that you will still be earning money on the collateralized portion of your policy. Yes, this is true, and this does work over a block of time. I do it myself. But what if you take out a large loan in year 5, spend the money, and for the next 2 or even 3 years, the policy does not earn enough to cover the loan charge? Taking out too much money too soon creates risk and stress on the contract. Think longer term and make sure that you are giving the cash value time to grow, and take your loans accordingly. Get advice from your advisor or the insurance company before taking long-term loans. Be safe, not sorry. I will be posting a video on how policy loans work. Number 3, not doing annual reviews. You cannot just put your policy in a box and forget about it for 30 years like your grandparents' whole life policy. I can't tell you how many people I meet that have no idea how their policy is performing or even what they have. Most IULs have several crediting strategies and indexes to choose from, and you can make your allocations once a year. Some indexes are better during a steady market growth, and some are better when the market is volatile. Treat your policy as a business. Any business needs monitoring. Start a couple of months earlier before your renewal and do a little research to be ready to make changes. Number 4, thinking that IUL is a lifetime term policy. Term provides death benefit for a specific period of time. The most popular is guaranteed level term. If you are young, you can even get a 30-year term policy with a level rate. You pay a higher premium in early years to keep premium level as you get older. The insurance industry does not sell long-term level term that will exceed your life expectancy. Most companies will not sell a 30-year term past age 55, but this does vary. For short-term needs, sometimes the cheapest term is ART, called Annual Renewable Term. You pay for the mortality charges at your present age, and it will go up each year. With IUL, trying to minimum fund to lower premiums and create a lifetime term insurance does not work. IUL is better suited to maximize cash accumulation. You will have more flexibility, and there will always be a death benefit for heirs until your natural death. IUL can also work well for a cash need at death for estate planning purposes. Number 5, using a we-do-everything insurance company. Personally, I've always preferred companies that are life insurance only and do not also do casualty and health insurance. Their focus might not be 100% on life products. Losses from casualty insurance, such as hurricanes, can have an effect on the general account of the carrier. They may look to other products for more profit. I have found that products with the do-everything companies are usually not as competitive. Number 6, unrealistic expectations of earnings. If the market was never going to have a down year, then IUL indexing would not be needed. Buying the best illustration is like buying the best paint on a used car. Under the hood is more important. Illustrations are like looking at the future with rose-colored glasses. They never show a 0 year. But with a good product in design, the probability of meeting projections can be very high, starting with only paying the minimum IRS required death benefit. Having more cash in a policy will help keep expenses in check. Keep in mind that an IUL, in fact, is an insurance product. You insure your car and your home for loss. IUL insures you from market risk. But it is important to fund as if the economy will have ups and downs, as we all know it will. AG 49 and AG 49A are new regulations that keep a lid on what any product can project. In turn, this raises the probability of meeting projections shown, which is a good thing. Historically, there's never been a time where earnings were the same year after year after year. But the insurance industry's IUL strategy of indexing the indexes does work. And also remember that promises made by an advisor will not raise your future returns. Number 7, not selecting a quality product. Everyone has a budget for what they can put into an IUL, and all IULs have charges. The lower the charges, the more money will stay in your cash value pocket. Like any other business, IUL may be the focus of one company, but not another. Just because a company name is well advertised on TV does not mean a specific product is competitive. Not all products have the same design options to minimize expenses. Some companies may make up the difference, so projections look good by short-term subsidizing of the option budget or by using multipliers. Yes, I will be doing a video on multipliers. Have your advisor show you 2 or 3 companies. Here's an example of max funding with 2 different companies on a male age 38. Both are highly rated and active in the IUL marketplace. First, we're looking at IUL A and B, contribution of $24,000 a year for 20 years. Total contribution of $480. Initial death benefit for policy A is $456, and for policy B, $1.3 million. Death benefit at age 90 with policy A is about $243, and with policy B, $785. Distributions were only shown on policy A from 70 to 85, only 15 years, which was $120,242. Policy B, with no extra design, just doing basically a software solve for max income, is $194,500. That's a substantial difference. The total distributions for policy A from age 70 to 85 would be $1.8 million, and with policy B, 2.9. This is very significant. And the total, including the ending death benefit age 90, would be $2 million for policy A and 3.7 for policy B. Nothing was done different for both of these policies. It was just how the policies were designed and what the charges are. I hope you've learned something from this video and you will make an effort to avoid these 7 issues.